I know house prices will crash is a dramatic title, but in reality, at some point, they will crash because although there is some debate about this, in general, the boom and bust cycle is a part of the economic framework and is mostly considered completely unavoidable. So look, I can't predict when this will happen. What I can do is take you through the common things that have happened before every major house price crash in the last 40 years, so that you can be armed with the warning signs and knowledge to know what to look out for. I've broken this video down into 4 sections. They are 1, why do economic cycles occur? 2, what caused the 2008 housing market crash so we can learn from it? 3, what caused the 1990s housing market crash, so again we can learn from it. And from that, what's this all mean? How do you protect yourself? But before we get into it, the reason this is so important to me is because I've spent my life building a UK-wide home buying company, British Home Buyers, a nationwide estate agency, British Home Sellers, and my own personal property portfolio. So not only does that give me access to information you probably don't have, but getting this right is critical to mine and my client success. So please like and subscribe because it keeps me motivated and helps me out. And let's get into it. Section 1, why do economic cycles occur? Now, I started this video with this graph, which shows one generic economic cycle, when in reality, when you look at economic cycles over time, it tends to look more like this. So although there are ups and downs, the general movement is upwards. So when I titled this video saying house prices will crash, I'm not trying to be negative, nor do I think they will crash long term. Because in reality with this, you'll have the optimists that say property prices will never crash, long-term property prices are safe and always rise. And when you look at average house prices over time, it does tend to indicate this. Yes, there are ups and downs like the generic economic cycle graph I shared earlier, but overall the direction is upwards. But then you'll have a separate group of people saying a price correction is coming, beware, everything's going to crash. But again, when you look at the same data, but as percentage price changes in property over the years, you can 100% see what they mean. So in reality, with economic cycles, it's often 2 steps forward, 1 step back, rather than 2 steps forward, 3 steps back, if that makes any sense. But why do we have these cycles? Well, when you Google what causes economic cycles, this comes up. Because in reality, there are multiple things that affect cycles, but in plain English, what creates cycles is changes to demand and supply. So you and me wanting to buy and sell stuff. And that is usually disturbed by political decisions like lowering stamp duty, for example, or unpredictable external shocks like COVID or like war. So what actually caused the last 2 crashes and how might this help us in predicting the next crash? Section 2, what caused the 2008 house price crash? Now look, this graphic has a lot going on, but in reality, the house market crash was a multitude of things that went wrong at once. As one domino fell, it pushed up a whole bunch of others down with it. But in a nutshell, one of the main contributors to the broader financial crisis was the subprime mortgage crisis. Without going into huge detail, in short, what it was banks were lending more than they should due to poor regulation. They were creating all sorts of products. They wanted to lend more because it made them more money. So they lowered the requirements of people borrowing. So the lending was riskier. We had things like 100% or even 100%, 110% mortgages back then, self-certified incomes. What that led was when the riskier mortgages started defaulting, because banks were lending more than they should against the money they actually had to cover it, they couldn't cover those losses, causing the financial institutions to collapse. Now, I know that is a simplified version of events, but in reality, the significant trigger could be described as an external shock, a poorly regulated financial sector pumping far too much money in a system relative to the money it had held to cover it. However, in the 1990s, the house market crash there was triggered for very different reasons. Section 3, what caused the 1990s house price crash? price crash in the 1990s, on the face of it, was triggered by different reasons, but there are similarities that I'll run through. In the 1970s, a third of homes were affordable social housing, whereas now it's a fraction of that. But what social housing created was a decent alternative to home ownership and a massive competitor to the buy-to-let market. But then in the 80s, the Thatcher government turbocharged the right to buy for social housing. What this basically meant is anyone living in social housing could buy their council house at a reduced rate. And at the same time, the amount of homes being built to replace the bought up social housing dropped. Now, on the face of it, in the mid-80s, everything seemed great. More and more people were homeowners, but at the expense of reducing the amount of social housing in the sector available to everyone. At the same time, mortgages in the 80s and 90s became widely more available and the barrier to borrowing decreased a lot. So, like with the 2008 crash, the mortgages got riskier, which is exactly what happened in the later crash in 2007, 2008. So ultimately, when interest rates increased to attempt to rein in what was perceived to be a completely overinflated economy, fueled by way too much money in it, people couldn't keep up with their mortgages. Quite similar to what's happening now, isn't it? Repossessions climbed, dropping house prices, and you can see how this was much the same in 2007, 2008 house price crash on this graph. But the wider problem inherited by the sell-off of social housing was as more and more people could borrow money due to fewer controls of mortgage lending, there just weren't enough homes being built to offset it to control price growth. In 1992, half the number of homes were built compared to 20 years previous. Section 4, what does this all mean? How can you protect yourself? Of course, you can make your own conclusions from everything I've shared with you, but to me, there are common denominators from the last house price crashes to watch out for that we can apply now. They are, to me, one, government or industry fueling excessive home buying in any form by promoting one, high loan to value rates, or two, incentivizing buy-to-let, which fuels demand, for instance. Next, house prices increasing too quickly relative to inflation and wage growth. And finally, not building enough new homes, which aids fueling house price growth. So right now, it's a good thing house prices are stagnating and dropping relative to inflation. We need to make sure that house prices don't rebound the moment interest rates drop a little later this year. If that happens, we're then going to enter the danger zone of house prices booming whilst mortgage requirements relax. And that could create problems down the road that we just don't realise. So to protect yourself, make sure to, one, not overextend yourself, because just because you can get 95% mortgage doesn't mean you should. And two, try to build equity in your home, in your finances, to be confident you can weather what will be inevitable economic cycles we'll all experience. I'll see you in the next video.